Usually when we talk about a medical diagnosis, there's this expectation of like clinical precision.
Oh, absolutely.
Like you break your arm, the x-ray shows that jagged white line across the radius, and the doctor just points to the screen. It's visible, it's perfectly categorized, and honestly, it's highly comforting in its clarity. Broken or not broken,
Right. I mean, the human brain really craves that binary reality. We want the data to present this undeniable truth without requiring any real interpretation. We want the flashing red light or the solid green light.
Exactly. But then you step into the world of post-merger corporate accounting, and suddenly that x-ray machine is just completely compromised.
Yeah, completely useless.
Right. We look at the diagnostic landscape, and it is just overwhelmingly murky. You look at the headline numbers flashing across your trading screen, and they don't actually tell you if the company is, healthy, sick, or somewhere in between.
It's the absolute definition of diagnostic muddy waters. And for a retail investor who's relying on automated news alerts to make portfolio decisions, I mean, that murkiness is actively dangerous.
Yeah.
You're making buy or sell decisions based on an x-ray that was calibrated incorrectly.
Which brings us to the patient on the table today. Welcome to this deep dive, by the way. Today, we're taking our Talk Tickers approach to FuboTV.
Huge one.
Yeah, they just released their first earnings report after swallowing Hulu Live. This is their Q1 2026 earnings call, covering the very first quarter. They are reporting as a combined, fully integrated entity following that massive late October 2025 business combination.
And this is exactly why we're doing this deep dive. Because on paper, to the untrained algorithm, the numbers might actually look like a disaster.
Yeah, right. But if you actually know how to read the pro forma data, there is a fundamental transformation happening here. So for everyone listening, you know the drill. We are going data forward, using plain language, sharing our opinions, and giving you actionable takeaways. Let's tear up the automated x-ray and look at the actual patient.
I mean, the market has been holding its collective breath for this specific moment. When you combine two distinct streaming infrastructures, both with their own massive subscriber bases, unique licensing agreements, different tech stacks, you are attempting an incredibly complex operational surgery. Everyone wanted to see what this combined beast actually looks like under the hood now that the initial shock of the merger has finally settled.
Well, let's start with the scoreboard, because before we can understand the strategic roadmap for the rest of 2026, we really have to establish a baseline.
Right, the headline numbers.
Exactly. If you pulled up your automated financial news feed on the morning of this earnings call, the headline number flashed a reported North America revenue of $1.54 billion.
Which, I mean, is an objectively massive number in isolation.
Yeah, it is.
But you have to look at the context. In the context of a Fubo and Hulu Live combination, $1.54 billion actually looked a little light to some of the high-frequency trading algorithms that parse these press releases in, like, microseconds.
But here's where we have to do some translation, because that reported number is heavily distorted by GAAP accounting rules. The actual true metric, the one management explicitly pointed to on the call, is the pro forma revenue of $1.68 billion.
Yes.
That represents a 6% growth from the $1.58 billion these entities collectively generated in the prior year. Now, I gotta say, whenever I hear the phrase pro forma on Wall Street, my defense mechanisms just activate.
Oh, 100%. It's a huge red flag usually.
Right. Translates to as a matter of form.
Yeah.
But historically, distressed companies use it to mean like the numbers we wish we had if everything went perfectly. It sounds like a Wall Street magic trick to make numbers look better.
What?
So are these numbers legit, or is this just accounting gymnastics?
It's totally legit in this case. But you're right, it's a notoriously abused accounting term. Companies will routinely strip out stock-based comp or one-time restructuring costs and just slap a pro forma label on it to make a terrible quarter look passable.
Yeah, exactly.
But in this specific instance, the dynamic is entirely inverted. The GAAP accounting rules, the generally accepted accounting principles, they're actually the thing creating the distortion. The pro forma number of $1.68 billion is the grounded mathematical truth of their earning power.
Okay, I really want to break down exactly why that is, because it fundamentally alters how you value the stock. So the transaction between Fubo and Hulu Live officially closed in late October of 2025, October 28th to be exact.
Right.
And in the eyes of the SEC and the accountants, Hulu Live was designated as the accounting acquirer in this transaction.
And that designation is the absolute linchpin of the whole distortion. Because Hulu Live is the primary entity absorbing Fubo into its financial books, the reported GAAP revenue only includes the historical run rate of the acquiring entity up until the closing date.
Okay, so wait.
So that $1.54 billion number includes a full 3 months of Hulu Live's revenue for the quarter. However, it only includes Fubo's revenue from October 29th through December 31st.
Wow. So it's literally missing 28 days of Fubo's revenue from the month of October.
Exactly.
I mean, Fubo was operating, they were collecting subscription fees, they were serving advertisements, but because of this line in the sand drawn on October 28th, nearly a full month of a multi-billion-dollar run rate business simply vanishes from the headline metric.
It vanishes. It's the equivalent of a bank evaluating your mortgage application, but like arbitrarily deciding to ignore your February paychecks just because you switched your direct deposit to a different checking account mid-month.
That's a great way to put it.
It fundamentally misrepresents your annualized earning power. I mean, the GAAP rules are rigid for a reason. They prevent chronological double counting during mergers, but they often just fail to capture the operational reality of the business in the immediate aftermath of a close.
Which makes management's focus on that $1.68 billion pro forma revenue, not just marketing spend, but a completely necessary clarification. They're essentially saying, let's align the timelines. If this combined entity had been operating together since day one of the quarter, this is the actual cash that would have flowed through the system.
Right.
And honestly, posting 6% year-over-year growth to reach that $1.68 billion is a massive sigh of relief.
It proves the core thesis of the merger because, the biggest fear when two massive consumer subscription platforms merge is cannibalization.
Oh yeah, people having both.
Exactly. Analysts were terrified that a huge chunk of users had both Hulu Live and Fubo for different niche reasons, and the moment they merged, those users would just cancel their redundant subscription, leading to a massive contraction in top-line revenue. A 60% growth rate proves that the overlap was either minimal or the combined value proposition was strong enough to attract net new users that offset any of that redundancy churn.
And the sheer scale they've achieved is frankly hard to wrap your head around. They ended the quarter with 6.2 million North American subscribers. That officially makes the combined Fubo entity the second largest virtual MVPD in the United States.
Multi-channel video programming distributor?
Yeah, it's the modern, broadband-delivered evolution of the traditional cable bundle.
And sitting at the number 2 spot is a staggering historical achievement for Fubo. Think back to their origins, right?
Yeah, the soccer stuff.
Yeah. They started as a niche, highly specific platform targeting hardcore soccer fans who wanted to stream obscure European leagues. For years, the prevailing wisdom on Wall Street was that Fubo would inevitably be crushed under the heel of big tech. They were competing against YouTube TV, which is backed by Alphabet's infinite balance sheet.
And to be fair, YouTube TV is still the undisputed king of the hill, sitting somewhere around 10 million subscribers. But Fubo, consolidating its position at 6.2 million, creates a definitive duopoly in the live streaming space. They have completely separated themselves from the legacy telecom players who tried and totally failed to build virtual bundles.
But scale is a double-edged sword in the media distribution business. Historically, Wall Street looked at Fubo's subscriber growth and actually penalized the stock for it.
Because of the costs, right?
Exactly. The bare thesis was that because of escalating sports programming rights and carriage fees, Fubo was essentially selling dollar bills for 90 cents. The more subscribers they added, the more money they lost.
Which brings us to the profitability metrics. Because revenue and subscriber counts are ultimately vanity metrics if the underlying unit economics are inverted.
Right.
So looking at earnings per share, or EPS, they showed a loss of 2 cents per share for the quarter, calculated across roughly 351.9 million Class A shares and 947.9 million Class B shares.
On the surface, a loss is a loss. But we have to analyze the vector of that loss. The trajectory is what actually matters to institutional capital. If we look at the reported net loss for the quarter, it compressed massively. They went from a $38.6 million loss in the same period last year down to a $19.1 million loss.
Wow. And if we apply that same pro forma lens to account for the missing 28 days of Fubo's operations, the improvement is even more dramatic. The pro forma net loss narrowed to $46.4 million, which is being compared against a staggering $130.4 million loss in the year prior period.
It's huge.
They managed to slash their operational losses by nearly 2/3 while undergoing one of the most complex corporate integrations in the media sector.
That is the operational leverage beginning to materialize right there. But what's fascinating here is the metric that truly caught my attention. The number that completely redefines the valuation model for this company is their adjusted EBITDA.
Earnings before interest, taxes, depreciation, amortization.
Right, which strips out the non-cash accounting charges and the debt servicing to give you the purest look at the actual cash-generating capacity of the core business operations.
And the pro forma adjusted EBITDA for this quarter hit a positive $41.4 million.
Incredible.
They didn't just inch their way over the profitability line, they surged past it. That $41.4 million nearly doubles the $22 million in adjusted EBITDA they posted in the prior year.
This is a foundational shift for the company's narrative. This marks their third consecutive quarter of positive adjusted EBITDA. For a retail investor who has held Fubo stock through the turbulence of the last 3 years, you're intimately familiar with the cash burn anxiety.
Oh, absolutely.
Every analyst note, every short seller report hammered the exact same narrative. Fubo will run out of cash before they ever reach critical mass.
The bears were convinced that the high variable costs of licensing content and the business model was just fundamentally broken. They argued it was mathematically impossible for an independent streamer to turn a profit without owning the underlying content.
And by posting 3 consecutive quarters of profitable EBITDA, management has empirically dismantled that bear thesis. They've proven that there is a critical mass inflection point, and it appears to be right around that 6 million subscriber mark, where the subscription revenue and the advertising yield finally outpace the fixed and variable programming costs. The business model works. It generates real, sustainable, positive operational cash flow.
So the patient's vitals are actually incredibly strong once you adjust the X-ray machine. $1.68 billion in true top-line revenue, 6.2 million paying subscribers, and a surging operational profit margin.
Yep.
But knowing the numbers are strong is only half the battle. We need to understand the structural mechanisms driving this efficiency. How is a company that just underwent a massive, highly disruptive merger managing to expand its profit margins so aggressively?
The answer lies in the specific operational synergies unlocked by the Hulu Live combination. Management dedicated a significant portion of the call to laying out a multi-stage integration roadmap. And the most immediate, highest impact driver, what they're calling stage 1, is the advertising infrastructure overhaul.
Okay, yes.
Fubo is currently in the process of migrating its entire ad tech stack into the Disney ad server. That migration goes live later this month.
I really want to dissect this because a lot of retail investors see ad tech migration in a press release and their eyes just glaze over.
Oh, it sounds so boring.
Right. Sounds like back-end IT maintenance. If I understand programmatic advertising correctly, we're essentially talking about the software that auctions off commercial breaks in milliseconds. But how does simply changing the software provider alter the fundamental revenue architecture of the business? It sounds like taking a local hot dog stand and dropping it inside the Magic Kingdom. Does changing the software really change the revenue that much?
It is so much more than a software upgrade. Your hot dog stand analogy is actually perfect. It is fundamentally changing the marketplace where your inventory is sold. Think of programmatic streaming advertising as a massive high-frequency commodities exchange.
Okay.
When Fubo operated as a standalone entity, they had a respectable but ultimately isolated pool of inventory. They generated around $100 million historically in ad revenue, but they were operating their own independent exchange.
So they had to employ their own dedicated ad sales teams, building bespoke relationships with ad agencies, trying to convince buyers to manually allocate budget specifically to the Fubo platform.
Precisely. And in the programmatic space, scale is absolutely everything. When you operate an isolated exchange, you suffer from structural inefficiencies. The 2 metrics that dictate the lifeblood of ad revenue are fill rate and CPM.
And for anyone who doesn't know, CPM is the cost an advertiser pays per 1,000 impressions.
Right. If your standalone sales team can't find enough buyers willing to pay your target CPM at any given millisecond, your commercial break runs empty. You show a generic, "We'll be right back" slate.
Which we've all seen a million times on streaming.
Exactly. And that is a devastating blow to your fill rate. You are leaving pure margin cash on the table simply because of a lack of buyer density.
But by migrating into the Disney ad server, Fubo is abandoning its isolated exchange and plugging its inventory directly into one of the largest, most sophisticated programmatic dark pools on the planet. Fubo's commercial breaks during live sports are now being pooled and auctioned alongside premium inventory from Disney+, ESPN+, and Hulu.
The implications for buyer density are profound. When a multinational conglomerate like Procter & Gamble or an automotive giant like Ford allocates a $100 million quarterly budget to Disney's advertising tier, they aren't manually picking individual shows.
Right.
They're utilizing Disney's algorithmic yield management tools to reach specific audience demographics across the entire ecosystem.
So Disney's unified ad tier algorithmically sweeps up Fubo's sports inventory to fulfill those massive pre-committed agency buys. The risk of an unsold commercial break essentially drops to zero.
The fill rate inherently maximizes, but the real leverage is the pricing power. Disney commands a premium CPM because they offer unparalleled cross-platform attribution and massive reach. They have thousands of enterprise buyers actively bidding against each other via API in real time. By inserting Fubo's highly coveted live sports inventory into that hyper-competitive auction environment, the clearing price for every single impression naturally rises.
And the transcript was incredibly explicit about the expectations here. Management stated they are modeling a double-digit uplift in both CPM and fill rates resulting directly from this migration.
And that is where the math becomes staggering for the bottom line. If you take that historical 100 million baseline of Fubo's standalone ad revenue and you apply a 15 or 20% systemic increase to the fill rate, and then you compound that with a 15 or 20% algorithmic increase to the CPM, the flow-through is explosive.
Because advertising revenue carries incredibly low marginal costs compared to subscription revenue.
Right. That compound growth falls almost purely, 100%, directly to the EBITDA line.
It's an overnight structural margin expansion. They don't have to hire more salespeople. They don't have to acquire more subscribers. They just flip the switch on the Disney server, and the same inventory suddenly yields tens of millions of dollars more in free cash flow. It completely illuminates why Fubo was so desperate to execute this merger.
The ad tech synergy is the undeniable crown jewel of the combination. But, the quarter wasn't entirely defined by smooth operational victories.
No, it wasn't.
There was a highly contentious, highly public conflict that dominated the headlines and caused significant anxiety for investors heading into the sprint.
The NBC Universal blackout.
Oh.
It was the elephant in the room. For context, Comcast, the parent company of NBC Universal, abruptly ceased renewal discussions with Fubo in early January. This happened almost immediately following the Versant spinoff. The negotiations collapsed, and Comcast pulled their signal. Fubo's platform was entirely devoid of NBC content for over 4 weeks during the heart of the quarter.
In the live streaming industry, losing a major broadcast network is historically viewed as an existential crisis. I mean, NBC carries Sunday Night Football, massive PGA golf tournaments, the Premier League.
Yeah.
For a platform like Fubo, whose entire brand identity is tethered to being the ultimate sports aggregator, losing NBC should have triggered a catastrophic wave of subscriber churn.
Here's where it gets really interesting to me. I look at that setup, and I assume the platform bleeds users by the hundreds of thousands. A sports streamer losing NBC sounds like a death sentence. Why didn't their subscribers flee? Because the actual reported data defies all conventional industry logic. Fubo reported that their standalone subscriber base actually grew by 3% year over year, completely absorbing the impact of the 4-week blackout.
It's probably the most fascinating behavioral anomaly in the entire earnings report. When a distributor loses a Tier 1 network, the standard playbook is to issue apologies, point fingers at the greedy conglomerate, and watch your users migrate to a competitor.
Right.
But Fubo management demonstrated an incredible degree of product agility here. They leaned heavily into their Fubo sports package.
This is their skinnier, heavily discounted tier that fundamentally strips out a lot of the bloated entertainment and news networks, focusing purely on core sports channels. It's a package that critically never included NBC to begin with.
Exactly. So when the blackout hit the primary package, management immediately recalibrated their marketing funnel. They offered clear communication to their frustrated users. We're fighting to get NBC back without raising your monthly fees. In the meantime, if you want to downgrade to our streamlined sports package, you can save significant money and still retain access to ESPN, CBS, Fox, and all your regional sports networks.
They aggressively preserve the consumer relationship by offering immediate financial compensation through a downgraded tier. But what really saved them, I think, was a massive shift in modern consumer psychology.
Oh, definitely.
5 years ago, a consumer might have canceled Fubo entirely and moved to YouTube TV to get NBC back. Today, consumers are incredibly adept at stacking subscriptions.
The fragmentation of the streaming market has inadvertently trained the consumer to build their own bespoke bundles. A massive cohort of Fubo users evaluated the landscape and realized they loved Fubo's proprietary multi-view interface, they needed Fubo for their specific local regional sports networks, and they simply couldn't replicate that setup elsewhere.
So instead of churning, they kept their Fubo subscription active and simply downloaded Comcast's direct-to-consumer app Peacock for $6 a month to bridge the gap for Sunday Night Football.
It completely neutralized Comcast's leverage. The distributor thought they could force Fubo to cave by weaponizing consumer anger, but the consumer just... forced experiment yielded a piece of data that I think changes the long-term trajectory of the company. Management noted on the call that the Fubo Sports package actually demonstrates a 30% higher retention rate than their legacy full-price tier.
30% higher retention on a cheaper product tier is a holy grail metric in the sauce world.
It is.
Churn is the silent killer of any subscription business. You spend massive amounts of capital acquiring a user, and if they cancel after 3 months, you lose money on the cohort. If you can keep a user in your ecosystem 30% longer, the lifetime value of that specific customer expands exponentially.
It fundamentally alters the unit economics. The market has been demanding a skinny sports bundle for a decade. People are exhausted by subsidizing reality television and 24-hour news networks they never watch just to access live sports. By forcing the blackout, Comcast inadvertently forced Fubo to stress test this streamlined, lower-priced sports package at scale.
And it worked.
It proved the sheer resilience of their core sports-centric value proposition. There's a massive, highly loyal demographic that vastly prefers a $50 streamlined package over an $85 bloated cable replacement. Losing the negotiation with Comcast might have been the best thing to happen to Fubo's product development cycle. It was like accidentally discovering penicillin because you left a petri dish out in the lab.
That's a great analogy.
They stumbled into a highly profitable, sticky product tier out of sheer necessity.
And realizing the sheer power of that Fubo Sports package seamlessly transitions us into the next major catalyst discussed on the call. What management defined as stage 2 of the integration plan, the ESPN commerce flow.
If stage 1, the ad server migration, is about maximizing the revenue extracted from the existing user base, stage 2 is entirely focused on turbocharging the acquisition of net new users.
Right.
Fubo is currently engineering an integration to place that highly successful Fubo Sports package directly into ESPN's native digital commerce flow, positioned right alongside the Disney bundle.
Let's clearly define what commerce flow means in this context, because the user experience is everything here. Imagine you're a sports fan browsing ESPN.com or scrolling through the ESPN mobile app. You're reading an article about an upcoming match or checking real-time scores, and you encounter a prompt to watch the game live. Instead of ESPN simply kicking you out to a cable provider login screen, there will be a native, frictionless checkout cart right there in the app.
And within that native checkout experience, Fubo Sports will be presented as a primary purchase option. You can subscribe to ESPN Plus, you can purchase the comprehensive Disney streaming bundle, or with a single click, you can purchase the Fubo Sports package.
Now, I look at this and I have to play devil's advocate for a moment. If a user is already inside the ESPN ecosystem and Disney offers them their own proprietary bundle, why would that user choose to purchase Fubo instead? Doesn't Disney's own product cannibalize this effort?
It really comes down to the comprehensiveness of the live TV ecosystem. The Disney bundle is phenomenal for on-demand content and standalone ESPN Plus exclusive broadcasts.
Sure.
But the hardcore sports fan still needs access to CBS for the NFL, Fox for college football, and critically, the fragmented web of regional sports networks for their local NBA and MLB teams.
The RSNs.
Exactly. Fubo aggregates all of that alongside the ESPN linear networks. Disney recognizes that they cannot fulfill the entirety of a hardcore sports fan's needs alone. By offering Fubo within their checkout flow, Disney takes a cut of the transaction while keeping the user tethered to their digital ecosystem.
It's a mutually beneficial distribution partnership. But for Fubo, the financial implications are just staggering. It entirely revolves around redefining their CAC, their customer acquisition cost.
CAC is the definitive metric that dictates whether a high-growth subscription company eventually achieves massive profitability or slowly bleeds to death. Historically, Fubo was forced into brutal performance marketing battles.
Yeah, fighting for eyeballs.
Right. To acquire a new subscriber, they had to bid against every other streamer on Meta, Google, traditional television. They were paying premium rates to intercept users on social media and drag them over to the Fubo platform.
It's a capital-intensive, low-conversion grind. But this ESPN integration fundamentally rewires that funnel.
ESPN reaches 4 out of every 5 adults in the United States. They possess a top-of-funnel fire hose of highly qualified, intent-driven sports fans that numbers in the hundreds of millions of unique visitors every single month. By embedding the Fubo purchase option directly into that organic traffic stream, Fubo's reliance on expensive external performance marketing just plummets.
They're essentially outsourcing their customer acquisition to the loudest megaphone in the sports world. And if you drastically lower your CAC while simultaneously migrating those new users onto a Fubo Sports tier that boasts a 30% higher retention rate, your customer lifetime value to CAC ratio, the LTV to CAC ratio, it goes parabolic.
It's the exact same structural playbook that allowed YouTube TV to scale to 10 million subscribers so rapidly.
Wow, really?
Yeah. YouTube TV didn't win solely on product features. They won because Alphabet owns YouTube, the largest video platform on Earth, and they aggressively funneled that existing massive audience directly into their premium TV service at a near zero acquisition cost.
That makes total sense.
Fubo is finally building a comparable top-of-funnel apparatus by utilizing ESPN's unparalleled digital footprint.
So the structural foundation of the business is objectively strengthening. We've established that the pro forma numbers are robust, the operational drivers, the programmatic ad server migration, the strategic resilience against the NBC blackout, and the massive ESPN acquisition funnel. They're all theoretically aligning for a massive breakout, which makes the next phase of our deep dive incredibly fascinating.
The guidance.
Let's look at management's guidance and how they're navigating the profound fog of 2026. Because if the past quarter was so operationally triumphant, Wall Street hates uncertainty. Why wouldn't a company hitting its stride give us a forecast? Management was so frustratingly tight-lipped about the remainder of the fiscal year.
The forward-looking signals provided on the call were exceptionally sparse, you're right. Management explicitly stated that they're establishing no guardrails yet for 2026. They declined to provide specific year-end subscriber targets, and they offered no exact revenue forecasts or EBITDA guidance for the upcoming quarters.
And algorithms are notoriously unforgiving when it comes to uncertainty. The modern market trades heavily on whether a company beats, meets, or misses its internal forward guidance. When a company abruptly pulls guidance entirely, the algorithmic assumption is almost universally negative. It triggers a risk-off response. So again, if Fubo is hitting its stride and posting positive EBITDA, why invite that algorithmic punishment by refusing to provide a triumphant forecast?
Because offering precise guidance under the current macro conditions of the merger would be fundamentally irresponsible. You have to separate the algorithmic demand for data from the reality of operating a massive, recently merged enterprise. Think about the timeline. At the time this earnings call took place, Fubo and Hulu Live were only 98 days into their combination.
Oh, wow. Only 98 days.
98 days. You simply do not fully understand the operational cadence, the hidden friction points, or the true organic growth rate of a merger of that magnitude in 3 months.
The paint is literally still wet on the organizational charts.
It is. Furthermore, the massive catalyst we had just spent 20 minutes discussing the Disney ad server integration and the ESPN commerce flow. They're deeply transformative, but their exact launch timelines and the speed of consumer adoption remain totally variable. The ad server goes live later this month, but how quickly will the programmatic algorithms fully optimize the Fubo inventory? It might take weeks, it might take a full quarter.
And the ESPN integration is still in active development. If that native checkout flow launches flawlessly in May, before the summer sports lull, it radically changes the subscriber math.
Yeah.
If technical delays push that launch into late August, right before the NFL season, the revenue recognition shifts entirely into Q3 and Q4.
Precisely. And that doesn't even factor in the unresolved NBC Universal situation. If Comcast suddenly capitulates and returns to the negotiating table tomorrow, Fubo has to immediately adjust their tier pricing, their marketing spend, and their margin projections. There are simply too many massive, unresolved variables.
So management made a calculated decision. They're choosing to endure short-term Wall Street frustration, rather than establishing a hard, quantifiable target based on incomplete data, only to miss it later because the software integration was delayed by 3 weeks.
Right. It's a mature, conservative approach to corporate governance, even if it causes immediate anxiety for retail traders.
But the lack of financial guidance wasn't the only announcement giving retail investors severe heartburn during the call.
Oh boy. No, it wasn't.
We have to address the most controversial mechanical move discussed, the planned reverse stock split. Fubo management announced their intention to execute a reverse stock split before the end of fiscal Q2 2026. So what does this all mean? To a retail investor, reverse split usually feels like slicing a small pizza into bigger slices just to pretend there's more food. It causes panic.
The psychological reaction is visceral, and historically it's somewhat justified based on how the tool has been used by other companies. But as analysts, we have to divorce the emotional response from the mechanical reality of the action.
Right, let's break down the actual mechanics of a reverse split, because the conventional analogies often fail to capture what is actually happening. I see people constantly use that pizza analogy, arguing that you haven't actually created more food, but that completely ignores the market microstructure. What does a reverse split actually accomplish mathematically?
A reverse split compresses the total number of outstanding shares while proportionally increasing the price of each individual share. Imagine a company has 100 shares outstanding, trading at $1 each. The total market capitalization is $100.
Okay.
If the board executes a 1-for-10 reverse split, the company now only has 10 shares outstanding, but the market price of each share instantaneously adjusts to $10. The market capitalization remains exactly $100. If you own 10 shares at $1, you now own 1 share at $10. The fundamental value of your equity holding has not changed by a single cent.
Okay, if it's a mathematically neutral event that fundamentally changes nothing about the company's valuation, why do corporate boards execute them? And why does the retail market hate them with such intense passion?
Retail investors despise reverse splits because they are overwhelmingly utilized by distressed microcap penny stocks fighting for survival. If a failing biotech company sees its stock price bleed down to 15 cents a share, they face imminent delisting from major exchanges like the NASDAQ, which require a minimum $1 bid price.
Ah, I see.
To avoid being relegated to the over-the-counter pink sheets, the distressed company executes a reverse split simply to artificially inflate the share price above the compliance threshold. It's a desperate, dying gasp to maintain exchange liquidity.
It's a red flag indicating fundamental business failure.
Exactly. But that is empirically not the situation with Fubo. The CFO, John Giannidis, was emphatic on the call. He categorized the move strictly as corporate hygiene. Fubo is not fighting off bankruptcy. They're sitting on $458.6 million in cash equivalents. They just posted multiple quarters of positive adjusted EBITDA. They are in no danger of imminent delisting due to business failure.
Then what is the strategic objective of compressing the share count if it isn't survival?
The objective is institutional accessibility and volatility reduction. Following the merger with Hulu Live and years of prior capital raises, Fubo has a bloated share structure. They have over 1 billion shares outstanding across their Class A and Class B classifications. That massive denominator naturally dilutes the per share price, keeping the stock trading in the single digits.
And single-digit stock prices create massive friction for institutional capital.
Massive friction. There are huge pools of institutional capital mutual funds, pension funds, university endowments, sovereign wealth funds that operate under strict, inflexible internal bylaws. Many of these funds are literally prohibited by their compliance departments from initiating positions in stocks that trade below $5 or $10 a share, regardless of how strong the underlying business fundamentals might be.
Because low-price stocks are structurally susceptible to massive daily percentage swings driven by retail day traders and algorithmic momentum trading. Institutional capital requires stability. They cannot deploy hundreds of millions of dollars into an asset that swings 8% a day on low volume.
By executing the reverse split, Fubo artificially elevates its share price from, say, $2 to $20. In doing so, they instantly unlock access to those massive institutional pools of capital. They elevate the stock out of the realm of retail day trading speculation and align their equity structure with the massive scale of their newly combined multi-billion-dollar revenue stream. It's an administrative maneuver designed to attract long-term, stable institutional shareholders.
They have a multi-billion-dollar business. They need an equity structure that mirrors a mature billion-dollar enterprise, not a volatile meme stock. It's a logical structural evolution. But we must acknowledge the reality of market mechanics here.
Human psychology and algorithmic programming will create short-term turbulence. Because the market largely views reverse splits as a distress signal, algorithmic trading programs will likely initiate automated sell orders on the news. Retail investors, reacting to the historical stigma, will likely capitulate and sell their positions. Even if the move is fundamentally sound for the long-term health of the stock, the immediate execution of the split will likely generate severe downward pressure and volatility.
The actionable takeaway is clear. Short-term mechanical pain is required to achieve long-term institutional stability. But the reverse split wasn't the only mechanical event that sparked a panic. During the call, a breaking news item hit the wire that sent the retail community into a frenzy. A fresh SEC filing dropped, showing that Disney was registering Fubo shares for sale.
I watched the real-time reaction on financial social media, and it perfectly encapsulates the danger of trading purely on automated headline alerts without reading the underlying documentation. The immediate narrative that spread like wildfire was that Disney was dumping their Fubo equity, that the merger was structurally failing behind the scenes, and that the parent company wanted an immediate exit.
It triggered a brief, violent sell-off during the live trading session. What was the actual reality of that SEC filing?
It was the definition of routine corporate housekeeping. When the Hulu Live merger closed in late October, the transaction involved a highly structured lockup agreement. Disney received a massive equity stake in the combined entity, but they agreed to a strict 24-month standstill and lockup period. Management explicitly confirmed on this earnings call that the lockup remains entirely intact and legally binding. Disney is legally prohibited from dumping those shares onto the open market.
If they are legally barred from selling, why did they file a registration statement with the SEC that implies a potential sale?
It relates to the intricate mechanics of SEC regulations post-merger. The filing in question was likely an update to a pre-existing shelf registration or an S-3 filing. When the corporate structure of the company fundamentally changes, such as Fubo absorbing Hulu Live existing registered securities must be re-registered or updated to reflect the new corporate umbrella and the new share classifications, it's a mandatory compliance exercise.
It's the corporate equivalent of legally updating your home address on your vehicle registration after you move to a new state. Filing the paperwork doesn't mean you're putting the car up for sale on Craigslist. It just means you're complying with administrative law. Disney is not liquidating their position. The lockup is ironclad. The panic was entirely manufactured by a misunderstanding of SEC administrative procedures.
Which is exactly why careful, methodical analysis is required. You have to look past the algorithmic headline and read the actual source documents.
Sifting through that noise brings us to the ultimate conclusion of our journey today. The bottom line. We've comprehensively broken down the pro forma financial realities, we've analyzed the profound operational synergies of the Disney ad server and the ESPN funnel, and we've demystified the executive maneuvers regarding guidance and reverse splits. Now it's time to deliver the actionable talk ticker's verdict for the retail investor listening right now. We must carefully weigh the definitive headwinds against the structural tailwinds. Let's begin with the bearish headwinds. If I'm considering deploying capital into this stock, what are the genuine fundamental risks that could derail the thesis?
The most immediate risk is the psychological fallout from the impending reverse split. As we discussed, even though it's a mathematically neutral event designed to improve institutional access, the market is frequently irrational in the short term. The psychological selling pressure from retail capitulation and algorithmic shorting will likely cause significant near-term downward momentum on the stock price. If you hold the stock, you must possess the conviction to weather that artificial storm.
Psychological selling is a devastatingly real force. The underlying math of the business doesn't matter if the broader market sentiment enters a state of panic. What's the next major headwind?
The unresolved NBC Universal blackout remains a lingering structural product gap. While the Fubo sports package demonstrated incredible resilience and the platform still achieved 3% growth, that dynamic is not permanently sustainable. If your core identity as a platform is being the ultimate, comprehensive premium sports aggregator, you cannot permanently exist without a major broadcast network that holds the rights to premier NFL and Olympic properties. Comcast holds a significant amount of leverage in that relationship, and a protracted stalemate could eventually degrade Fubo's brand equity in the broader market.
Right. And there was also a strategic risk raised during the Q&A portion of the call regarding Disney's internal corporate succession planning.
Yes, Laura Martin, a prominent analyst from Needham, brought up a highly compelling macro risk. During the week of the Fubo call, Disney made a significant internal announcement elevating Josh D'Amaro, positioning him as a highly likely successor to current CEO Bob Iger. D'Amaro is currently the chairman of Disney Parks, Experiences, and Products.
He's the executive fundamentally responsible for the physical theme parks and the cruise lines.
Exactly. The bearish interpretation of this succession maneuvering is profound. If an executive whose entire career is rooted in physical, real-world experiences assumes control of the Walt Disney Company, it potentially signals a massive strategic pivot. It could indicate that Disney intends to redirect immense capital and focus back toward their highly profitable fiscal assets, potentially deprioritizing the cash-intensive, fiercely competitive streaming and entertainment divisions.
Which poses a systemic risk to Fubo. Fubo's entire future growth trajectory is now deeply intertwined with Disney's digital infrastructure, relying on the Disney ad server for margin expansion and the ESPN commerce flow for user acquisition. If a new Disney CEO views streaming as a secondary priority and reduces investment in those digital ecosystems, Fubo could find itself tethered to a stagnating partner.
Fubo's CEO, David Gandler, responded to this concern by emphasizing the sheer momentum of Disney's digital operations and highlighting the deep functional integration between Fubo and the day-to-day operators at ESPN and Hulu. But at a macro level, a fundamental shift in the parent company's core philosophy is a valid risk factor that investors must continuously monitor.
Those are substantial grounded headwinds. The reverse split psychology, the NBC product gap, and the overarching Disney succession risk. But the market is a weighing machine. We have to balance those risks against the bullish tailwinds. What's the fundamental argument for accumulating shares of this company right now?
The bullish thesis begins and ends with the balance sheet, which is remarkably pristine for a growth stage company operating in the notoriously capital-intensive streaming sector.
Walk us through the specific financial architecture.
Fubo concluded the quarter sitting on $458.6 million in cash and cash equivalents. That is a fortress of liquidity. It provides them with an immense operational runway to execute their software integrations, aggressively market their new product tiers, and comfortably weather any short-term macroeconomic shocks without needing to return to the equity markets for dilutive capital raises. But the most impressive financial engineering occurred on the liability side of the ledger.
Let's talk about the debt, because 2 years ago, Fubo's debt profile was the primary weapon used by short sellers to suppress the stock. Fubo carried roughly $400 million in convertible senior notes that were scheduled to mature in early 2026.
That 2026 maturity date was a terrifying existential cliff for equity investors. In a macro environment defined by elevated interest rates and tightening credit markets, the fear was that Fubo would be unable to generate enough cash to pay off the principal and unable to secure refinancing on favorable terms. If a company hits a maturity wall and cannot secure refinancing, the result is often catastrophic dilution or outright restructuring.
But the CFO explicitly outlined how they neutralized that threat.
They executed a masterful restructuring. They successfully reduced that looming $400 million debt burden down to roughly $320 million. And more importantly, they completely dismantled the 2026 maturity wall, comfortably pushing the maturity dates out to 2029 and 2031.
The existential threat of a near-term debt default has been entirely eradicated.
Eradicated. They essentially bought themselves half a decade of uninterrupted strategic breathing room. The structural risk of holding the equity has fundamentally plummeted. And the reality is, given their current operational trajectory, they may not even need that extended runway. Which brings us to the second pillar of the bullish thesis, the fundamental transition from cash burn to cash generation.
3 consecutive quarters of positive adjusted EBITDA. They are no longer burning capital to survive. The core operation is self-sustaining.
And we must recognize that this $41.4 million in positive EBITDA was achieved before the massive cash flow catalysts have even fully materialized. That profit margin does not include the algorithmic double-digit ad revenue uplift expected from the Disney server migration later this month. It does not include the massive anticipated reduction in customer acquisition costs that will result from the ESPN commerce flow integration. Those are immediate, massive, high-margin revenue drivers sitting right on the horizon. The operational leverage in this business model is about to expand significantly.
We've meticulously analyzed the components. The JAP distortions, the ad tech synergies, the consumer resilience, the institutional mechanics of the reverse split, and the fortress balance sheet. It's time to synthesize this data into our ultimate opinionated talk tickers verdict. Are we fundamentally bullish or bearish on Fubo post-Hulu Live merger?
I believe the only rational approach is to adopt a highly bifurcated stance. I am exceptionally bullish on the long-term fundamental trajectory of the underlying business, but I remain extremely cautious regarding the short-term mechanical price action of the stock.
I share that exact sentiment. If you look purely at the operational reality of the enterprise, the expanding pro forma revenue, the proven ability to generate positive cash flow, the strategic removal of the debt maturity wall, and the unprecedented integration into Disney's advertising and distribution flywheels, the business is structurally sounder and more defensible than at any point in its corporate history. But the mechanical realities of the public markets, specifically the psychological volatility that will undoubtedly accompany the upcoming reverse split and the lack of explicit 2026 guidance guarantee a deeply toppy and unpredictable summer trading environment.
So if we distill this down to an actionable takeaway for the retail investor, if you currently hold a position in the stock and your thesis is built on the long-term structural advantages of the Hulu merger, you must mentally fortify yourself for the impending Q2 reverse split volatility. You cannot allow a mathematically neutral administrative change in the share structure to scare you out of a position if the underlying business continues to execute and generate expanding free cash flow.
You have to cultivate the discipline to ignore the daily algorithmic noise. Turn off the trading app, push notifications during the transition period.
Exactly. You must look past the turbulent surface water and focus on the deep currents. Conversely, if you are currently on the sidelines considering initiating a position, this impending period of engineered volatility might actually serve as a tremendous strategic advantage.
The structural roadmap, laid out for late 2026 and accelerating into 2027, a roadmap fully powered by the Disney programmatic advertising engine, the massive ESPN organic user acquisition funnel, and the absolute elimination of debt anxiety until the end of the decade, renders Fubo a demonstrably stronger asset than the market currently recognizes. If retail panic or algorithmic selling associated with the reverse split aggressively depresses the stock price, it could present an extraordinary asymmetric entry opportunity for a patient, long-term investor who understands the underlying mechanics. That is the essence of why we conduct these deep dives. You have to penetrate the muddy X-ray, diagnose the true operational health of the patient, and position your capital accordingly, independent of the automated headlines.
It is the only reliable method for a retail investor to survive and thrive in an equity market increasingly dominated by high-frequency algorithms reacting to out-of-context data points. You must relentlessly pursue the why and how behind the numerical outputs.
And as we conclude our analysis of the why and how, I want to leave you, our listener, with a final provocative strategic concept to mull over. A thought that builds upon the foundational synergies we've discussed today, but extrapolates them into the future of the media landscape. We've dedicated substantial time analyzing how Fubo's future growth will be heavily supercharged by embedding their checkout process directly inside ESPN's native commerce flow. It's a brilliant, highly efficient mechanism to structurally lower their customer acquisition cost. But it introduces a massive philosophical question regarding corporate sovereignty.
A question of ultimate leverage.
Precisely. If Fubo's growth is soon going to be supercharged by sitting inside ESPN's commerce flow, does Fubo remain an independent powerhouse? Or does this essentially turn them into a highly optimized, outsourced user acquisition tool for the Disney empire? When your biggest partner holds the absolute keys to your subscriber growth, who really holds the power?
It is the ultimate strategic paradox. The synergy that ensures your survival today might inadvertently build the cage that limits your independence tomorrow. We will be tracking the evolution of that power dynamic meticulously in the quarters to come.
We absolutely will. Thank you for joining us on this deep dive. We hope we helped clear up the diagnostic muddy waters surrounding this monumental corporate transition. Keep questioning the headlines, keep demanding to understand the mechanics behind the financials, and we will see you on the next deep dive.